We've now finished projecting the financial statements. We will use those integrated financial statements to extract the components we need to calculate free cash flow to the firm and free cash flow to equity. The idea with this worksheet is to extract the components and to have them readily available to calculate the free cash flow measures for each year over the forecast period. Remember, to calculate free cash flow to the firm and free cash flow to equity requires us to calculate various components for each year. We have to calculate NOPAT, or EBIT multiplied by 1 less the effective tax rate. We have to come up with figures for capital expenditure in each year, or CapEx. We also have to extract the change in working capital for each year, as well as figures for after-tax interest expense and the increase or decrease in net debt. We will do that in this worksheet. Remember, we want to keep all of our calculations dynamic by using formula and cell references rather than hard-coding any of the cells. We will begin by populating the figures for NOPAT. To do this, we simply reference the NOPAT figures in the integrated income statement. We populate the after-tax interest expense cells by referencing after-tax interest expense in the integrated income statement. NOPAT less after-tax interest expense gives us net income. We've already prepared two of the components we need to calculate the free cash flow measures. We have NOPAT and we have after-tax interest expense. We will now extract the change in working capital component that we require for the free cash flow calculations from the integrated financial statements. Remember, we need figures for the change in working capital or the additional investment made by the company into its working capital for each year over the forecast period. We need these figures to calculate free cash flow to the firm. We will calculate the change in working capital component in this section of the worksheet. We will extract it from the integrated balance sheet using the net working capital balances. The working capital balance on the integrated balance sheet is defined as current assets less current liabilities. It can be positive or negative. If current assets exceed current liabilities in a particular year, you have positive working capital. On the other hand, if current liabilities exceed current assets, you have negative working capital. But remember, the change in working capital component that we need for our free cash flow measures is a cash flow. Therefore, you need to think about the direction of that cash flow. If negative working capital increases year on year, which we can see is the case for Tesscow, its negative working capital gets greater or more negative year on year. This means the company has effectively increased its reliance on short-term finance from its suppliers. The current liability part of working capital exceeds the current asset part by a greater margin year on year. This means the current liabilities, such as accounts payable, have increased in importance over that year. In effect, we took inventory from suppliers, but no cash payment was required. This represents a cash inflow, so the change in working capital component will be positive in the free cash flow calculation. On the other hand, if the working capital balance moved in the opposite direction, if it became more positive year on year, the opposite would be true. Current assets such as inventory and accounts receivable would exceed current liabilities by a greater margin. In the case of accounts receivable, if this account increases, it means we have sold more inventory to our customers on credit. In effect, this requires an additional investment of cash to fund the inventory that we've handed over until the customer pays us back. Therefore, in this case, the change in working capital component would be negative in the free cash flow calculation, as it represents a cash outflow. To calculate the change in working capital component for each year over the forecast period, we take the working capital balance for a particular year and we subtract off the opening working capital balance or the prior year's working capital balance. This gives us the change in working capital year on year. In the case of Tesscow, we can see its negative working capital is getting more negative year on year. And this makes sense. Tesscow is a major grocery retailer. It has significant market power. It can use that market power to negotiate or to push its suppliers for better credit terms. It's useful to do a quick reconciliation to make sure we haven't made any mistakes. If we insert the opening working capital balance for a particular year, that is the closing balance from the prior year, we can then add the opening working capital balance to the change in the working capital for that year to arrive at a closing working capital balance. We can then quickly check that these closing working capital balances reconcile back to the integrated balance sheet. We can see that they do. We're assured that we haven't made any errors in that calculation. We will now calculate CapEx for each forecast year. We need the figures for CapEx to calculate free cash flow to the firm. CapEx will be calculated in this section of the reorganized financial statements. To calculate CapEx, we need to extract the additional investment or divestment in the company's long-term productive assets for each forecast year. We do this by using the integrated balance sheet to derive the change in the net long-term asset balances year on year. If the net long-term asset balance increases in a particular year, as is the case with Tesscow, we can see its net long-term asset balances are increasing year on year. This means the company has invested by acquiring more long-term assets in that particular year. It has increased its capacity. This represents a cash outflow. So the change in net long-term assets, or CapEx, will be negative in the free cash flow calculation. On the other hand, if the net long-term asset balance decreases in a particular year, the company has divested. It has sold some of its long-term assets, and it has reduced its capacity. Therefore, the change in net long-term assets, or CapEx, would be positive in the free cash flow calculation, as it reflects a cash inflow. In other words, as we sell the assets, we collect in the sales proceeds. To calculate CapEx for a particular year, we start with the net long-term asset balance for that year, and we subtract off the opening net long-term asset balance or the closing balance from the prior year. This will give us the change in the net long-term asset balance year on year. We can see Tesscow has consistently increased its net long-term asset balance year on year by investing additional amounts in its long-term assets. Again, we can do a quick reconciliation to check there are no errors. If we insert the opening balance of net long-term assets, and we add the change in net long-term assets during the year to the opening balance, we get estimates of the closing net long-term asset balance. We can compare this to the figures in the integrated balance sheet. They match, so we're confident that we haven't made any mistakes in this calculation. Next, we will extract the change in net debt from the net debt balances on the integrated balance sheet. It is important to point out the definition of free cash flow to equity that we're using. The definition requires us to add any increases in net debt that occur in a particular year. This definition determines the sign on the change in net debt. If debt increases in a particular year, that change in debt is added in the free cash flow to equity calculation. If debt decreases in a particular year, that change in debt is subtracted from the free cash flow to equity calculation. The net debt balance in the integrated balance sheet is defined as cash less debt. It can be positive or negative. It is positive if cash exceeds debt, and it is negative if debt exceeds cash. If the net debt balance moves in a more negative direction in a particular year, this means we have taken on more debt. Remember, the free cash flow to equity definition that we're using requires us to add any increases in debt. Therefore, if net debt moves in a negative direction, we need to add that change to arrive at the free cash flow to equity. In contrast, if the net debt balance moves in a positive direction, which we can see is the case with Tesscow, its net debt balance is decreasing year on year, or moving in a positive direction, this represents either an accumulation of cash or we have paid down debt. It represents a decrease in debt. Therefore, we need to subtract it from the free cash flow to equity measure. To calculate the change in net debt for a particular year in the reorganized financial statements, we begin with the net debt balance for that year. We then subtract off the opening net debt balance, or the closing balance from the prior year. This will give us the change in net debt for each year. We can see that Tesscow has been reducing its net debt, presumably by paying it down year on year. Therefore, we have positive changes in net debt in each year. If we add the opening balance for net debt to the change in net debt, we can quickly do an accuracy check. We need to check these closing balances match the closing balances for net debt on the integrated balance sheet. They do. We're confident that our figures are accurate. We can now insert our forecasts for equity. To do this, we reference the total equity figures in the integrated balance sheet. Finally, we can check our reorganized balance sheet balances. We do this to be sure we've left nothing out. We can see that total assets equals total capital, where total capital is comprised of net debt and equity. They balance, so we can now move on to calculating the free cash flows.